Good morning, ladies and gentlemen. Well, last week we had the passage in the House of the One Big Beautiful Bill, so we more or less know, unless the Senate is going to make some significant changes, which is very unlikely, what the path of fiscal policy is now. And we also know that monetary policy is on hold, really, for the foreseeable future. Besant then went on to the various TV programs to repeat the mantra: the deficit is not a problem as long as growth outpaces the growth of the deficit. But I believe they're still on an unsustainable path. Let's have a look what the market has done since Besant has come into office, really. And this is the term premium on a 10-year zero coupon bond. It's very, very slightly lower than when he came in. He came in around here, right? 68 basis points, and it's now 58. But what keeps on rising is real rates. Not so much in the tens, and this is where we are in tens. Where did he come in? He came in about here, so we are maybe 1 or 2 basis points lower. But if we look at 30s, we are a long way above. So we came in around here, 250, and we're now 272. The market is beginning to lose confidence that this path of the deficit is sustainable. It just means that term premium will continue to go out and real rates will continue to rise because the market is not confident that they have the budget deficit under control. You know my thoughts. I think that when you get to 285 to 3% in real rates on 30s, that is going to be a decent buy, not because it's something to do with real rates, but because the economy won't be able to sustain real rates that high and will slowly deflate. And that will make people switch out of equities into real rates primarily because nominals are what nominals are. I can't see much alternative to longer term continued steepening, but I don't think it happens next week. Next week we have the 2s, 5s and 7s, therefore the area that should be under pressure is going to be the 5s mostly. And let's have a look at what the yield curve did last week and what it's likely to do next week. So 2s, 10s did steepen a couple of basis points, but really the move is at the long end is 10s, 30s. That keeps on going out and it's now at very good support. I don't think it breaks it next week. It's much more likely that actually it retraces a few basis points. But you can see that this is really, at some stage it breaks and it heads down towards these levels, 70s. That is the path of least resistance. It's not going to happen next week, but it just shows you that at some stage the 30s are going to, spike higher. And that, to me, is going to be the opportunity to buy real long-term rates and lock in, a nominal yield, which is going to be quite decent for when the economy actually starts weakening, because 3% real rates is going to weaken this economy. I'm absolutely convinced of that. So 2s are completely stuck, trading in a very few basis point range, and that is as it should be because the Fed is absolutely on hold. I think that if you see these kinds of levels, the 414, 415, there will be a mass of buyers there, simply because it's unlikely to go anywhere close to Fed funds because we are still expecting the Fed to cut at least twice this year. And I think that it's likely that they will cut, if not twice, at least once. But a cut will be forthcoming at some stage. So really anything in the fours, twos are really not going to go a million miles. Fives, I still think that at some stage they will reach the 427 area, simply because I think the yield curve will continue to naturally steepen and the supply into the belly is going to be good enough over the course of the next few weeks and months to get it up to there, but I really don't see that it's going to go through there very much. Tens, I think that at some stage we test these highs for the year, but the real problem is the 30s. And at some stage you saw that this 511 area is very difficult to break. Again, I don't expect it next week. If anything, I expect the yield curve to flatten slightly into next week because of the auctions, but at some stage we are going to go higher and test this 5.25 level. And just for you to be aware of how important that 5.25 level is, this is TLT from its inception, and you can see that it really never ever traded below 81 something, right? Whether it's 8100 or 8110 or 8120, it really doesn't matter. Just think of all the headlines, the panic that will ensue if we start breaking these levels and make all-time lows in TLT. I think it's going to happen, but I think the reversal after that is going to be epic. Simply because, as I said, this economy will not be able to take real rates into the 3% at the long end. The housing market will stop functioning. Spreads will all go out. It's going to be a mess and a half. And buying, volatility there, buying calls on TLT, I think is going to be a wonderful long-term trade. From there, from the 80 area, I expect it to go to 90 in a month, or even 94 in 2. I expect this move to be brutal once it breaks these levels, simply because the economy is going to just roll over. And I just wanted to leave you with the 30-year gilt. This is the equivalent of the TLT that I showed you, those bottoms, right? All the way from 2001 all the way going forward, and we have broken, and the gilt tends to lead, and that makes me think that the likelihood that TLT is going to make the spikes down that I've been talking about are quite high, and that will be the opportunity to buy real rates. In Germany, the situation at the short end is much the same as in the US, i.e. we all know that the ECB will cut again at some stage, and therefore the twos are really unlikely to go above 2% anytime in the short term. So it's a trading market, 191 down to 168, and that's about as good as you can hope for. The tens are suffering from the same kind of problem as the US. The yield curve continues to steepen, or it doesn't want to flatten from whatever level it reaches. I still think that this 152 level in Bunds is going to be very hard to break, and I think that we are at some stage going to go back up and test those 290 levels. I just don't see any alternative. I can see that the spread between Germany and the US can keep on coming back in, and here is the tens. I can see it, going back out to say 202 or something like that, but that's about it. I just can't see it going any higher, simply because there is, you will get to such poor level of real rates in Germany. I mean, even now, real rates are very, very low in Germany. Why would anybody want to not hedge their real rates in the US, which are much, much higher, and hold those? And I still think that the 10s in the US are going to go higher, the 30s in the US are going to go higher and going to spike the 525 level. So why anybody would want to hold bonds to me is a mystery. I would much rather hold JGBs, I would much rather hold US swapped into my home currency than hold bonds. But there you go, it is what it is. The German curve keeps on doing nothing, and I think it will continue doing nothing. I don't think we break in the 2s, 10s this very, very important 88 level for a bit. I think it's much more likely to trade sideways and allow the 200-day moving average to catch up. And then eventually we break and we go down to this 127 level. And that is when I think it's going to be a Bund move, i.e. the 2s are going to be doing nothing and it's going to be a 40-50 basis point move in the Bund rather than anything else. So it's still wait and see, but that is the direction of travel in the 2s, 10s going towards minus 100, 127 basis points, and eventually I think even 184. But it's going to take a year. It's going to take a long time, and it just makes sense to me that that is what's going to happen. The dollar has been trading technically quite perfectly. It just about tagged one on 192, which I said was absolutely critical, and boom, all the way back down. Now the first support is 98.80, but I think that that is likely to give way, and then you have a bunch of support here between 98.30, as I said, and 97.30. If we translate that to a Euro FX, what it's basically saying is that at some stage we retest this 115.50 area, but we probably don't break it immediately. So it's the other currencies that try to make new lows. We trade the 116 back down to 113.50 range, but the path of travel, whether it takes 2 weeks, 3 weeks, or whatever, I think that eventually we reach these levels at 118 to 118.40 immediately, and with spikes up to whatever it is, 119. I think it's going to be very, very difficult to get it to stay in the 120s, but I think the path of least resistance is for another leg after maybe 1-2 weeks here to go up to 120. I just can't see any alternative to a weaker dollar. It's the only way to achieve this reshoring that they want into the US. You have to make the dollar cheaper for that to happen, in my view. The yen critical level is going to be 140.63. I think everybody is going to start screaming head and shoulders if it breaks there. Again, it could do it next week, but if it closes below that 140.63, I think the path of DXY is pretty much set. And you are looking as a first target somewhere, in the mid 130s, and then probably a rally back, but then the trend will be set. The 200-day moving average will be coming down quite quickly, and you'll be set for a move back down into the mid 120s. And that should coincide with that 120, 119, 120 level in Euro USD, and that's probably going to be a reasonable level that the administration is going to be happy with, and that is going to enable the US to carry out the policy it wishes to carry out with reshoring. Gold had a stellar week because the DXY had a bad week. And I think that that is likely to continue. While the dollar continues to be weak, I can't see how one can expect gold to be extremely weak either, regardless of what real rates are and regardless of what bond markets do. I think, it's likely to retest these spike levels as the DXY comes down to at least 34.50, where the weekly Bollinger Band is going to be, and the daily, because Monday, Tuesday will be again at this 34.50 level. So that marries with my DXY view. It's very, very unlikely that we see gold give up before DXY reaches its targets. GSG is still doing nothing, and that probably has something to do with the nuclear policy of the US. And as this is an index which is mostly comprised of oil, while the US turns nuclear, oil is really not going to have a big up move. So GSG is probably the wrong commodity sector to look at, but it's the best we have. DBC is really no better, and both of them show that inflation is unlikely to accelerate, which makes me think that, real rates, when the nominals get to where they have to get to for reals to be really high, is the place that you still want to be, because I just can't see how an economy like the American one can take 3% real rates and not have a major accident. It was a very interesting week in crypto land, and I sold tons and tons up there against my MSTR position, but I think now it's going to come back through this 106,200, and it's going to stop all these people out, and it's going to come down to the 200-day moving average around 93, 91, and get everyone absolutely stuffed. What I look at is this chart, and this is MSTR over 1.55 EBIT, because MSTR is leveraged. This is its range, and every time it gets up there, it's too much for MSTR and too much bullishness. And therefore we're coming back down to this level, and we're going to stay supported. Very much doubt that it breaks through here, but MSTR last week basically told you which way that market is going. It's now going to bounce around the 200-day, but that allows MSTR to stabilize. So MSTR stabilizes around 340, but that causes the liquidation in the BTC, which takes it down, a good 5%. I would have thought sort of this kind of area in 94 to 91 is favored. Equities are behaving textbook. So if we enlarge this chart, you will see that the break of 58.65 gave us the 57.65, and now we are in no man's land. It's so difficult to predict from here because the Trump tweet about 50% EU tariffs makes so little sense that if I was the EU negotiator, I would not respond to it at all. I mean, what is there to respond to? 50% tariffs on EU goods basically is nearly double the Chinese tariffs, and what, the EU is the US's biggest enemy in the world. It's such nonsense that how do you respond to it? How do you respond to utter nonsense? Well, I wouldn't. And therefore, that increases the likelihood that on June the 1st, he actually does put 50% tariffs, which would make, the stock market absolutely liquefy and probably all the way down to 54.80, that kind of thing. But in the meantime, it's not going to happen. I mean, how can you discount that he's going to do that next week? I just can't see how the market can discount that. And the 1st of June is it's next weekend. So what do we do in the meantime? Well, I guess in the meantime, we just tread water and hope he's not a complete idiot. The closer we get to the weekend and the less signs there are that either side is making progress or is happy with the negotiations, the more we will give up and start going down towards this 56-70 area. But I really can't see that we can be very far away from these levels. I mean, nowhere near the highs next weekend, because unless we get a tweet saying, yes, we've resolved it, yeah? In which case, I think the 58.65 level gives way and we probably start trading all the way to 6,003, where we give up again, because I don't think that this is over for a long time. And certainly I don't think that this 60.40 level, which is the highest monthly close we've seen, is likely to be broken very easily or very soon. NQ to me continues to trade much, much better than SPX. And I think that that should be the preferred vehicle for longs. I know that we have Nvidia on the 28th and anything can happen after that. But you can see where the high monthly close is, 21,500, let's call it. And that is precisely what we touched and backed off from. But look how little we backed off. On the weeklies, did we make a new low compared to the week before? No, we didn't. And did we even test 20,660? No, we didn't. So I think this market is trading a lot better, telling me that the strength in the US is going to come again from high tech. And it makes sense to me. The US is high tech. So if there's going to be any strength, this is the sector to be long of. And in that vein, this is QQQ over SPY. So I just wanted to show you a bit longer term, because we are back to the levels that we were during COVID. So we can't say that we are hugely overbought here. We had the run up for COVID, then we had the correction of that run up, and then we realized that we are probably going to get some more tech strength because the AI revolution will be upon us, whether it's robotics, AI, or whatever. It makes sense that QQQ should start outperforming SPY again. If it breaks this 89.60 all-time high, I really, really would not stand in the way of it. I would definitely jump all over it, because I think it has this much to go, and that's 83 to 86. That's at least an 8% move on top. It will happen, I'm absolutely convinced, and every time QQQ dips, I buy it against SPY. I think that's one of the safer trades for the next few months. Overall, I think it's going to be a quiet week. I think the yield curve is likely to flatten a tiny bit simply because of the auctions. I don't think the 30s are going to be doing very much at all because the data coming out next week is really all rear view mirror data. Q1, PCE, we know what it is. The only thing that could surprise us is durable goods. We know that the window of potential weakness is now open and is going to last for 4 to 6 weeks. And if there is no weakness there, then we should see a continued flattening of the yield curve, simply because you are unlikely to get anything from the Fed, and that will disappoint some people. And eventually the yield curve goes back to steepening, because people start saying, oh, there's no weakness in the economy, then, why buy even 30s? So that is what is most likely to happen. If there is weakness, then it's a continuing steepening of the curve. So there we have it. I think the trade next week would be to buy volatility when the SPX drops towards the end of the week if there are no tweets from Trump, because you will come into next Monday at completely different levels, because if 50% tariffs get imposed on June the 1st, the markets are going to liquefy. And if they're not, the markets are going to go quite a bit higher and test at least 58.65, and I would have thought go through it. So you'd want some very, very short-term calls and puts. So the likelihood that they're going to hit volatility expiring in the middle of not this week coming, but the one after, i.e. very early June, I think are minimal. And if they do, and we can pick some up at, on Wednesday or Thursday, assuming nothing has changed, that is going to make a hell of a lot of sense, because the week after that, we're going to be trading very, very different levels from the ones that we're at the moment. Thank you very much indeed, and tweet you tomorrow.